Hello and welcome to the Flow podcast by Finery Markets, where we talk about crypto market structure with industry leaders. And today I'm glad to have Alex Rifkin, the founder of Raw Protocol. Quite an interesting project involved in the interest rate markets within the digital asset space. And Alex, first of all, glad to have you here.
Thanks for having me.
Before we start, I'd like to make a confession. In my 16 years of financial career, I've been lucky enough to dodge the interest rate markets, and I've mainly spent my time within equities, FX, and most recently crypto. So please be gentle if you hear some dumb questions, maybe. And let's try to dive deeper into that market and help explain, all of our listeners and the entire community, how can that market be helpful, and how can Raw Protocol help evolve the digital asset market structure?
Of course, you're not the only one. I think I think rates markets are some of the best kept secrets in finance. Unless you're a professional investor, you probably never heard of it.
Exactly.
And if you are a professional investor, again, it's a kind of a specialized corner of finance. So yeah, I'm.
And another secret is that interest rate markets are actually by notional amount traded, or not traded, but just by the notional amount is probably the largest capital market.
That is 100% out for outstanding interest and notional
Exactly.
traded. These are funny numbers for open interest. We're
So,
talking
yeah.
hundreds of trillions of dollars.
Exactly.
Of volume
Exactly.
in notional open.
Which is, I guess, makes it even more interesting for our today's conversations. So let's start with the basics. Please explain in a very simple terms what is Raw Protocol, and let's make it pretty simple.
Of course. So the easiest way to describe us is a rates exchange. Rates meaning rate derivatives. So there are products that enable you to trade rates synthetically. Like in finance, as you know, anything can be traded. Anything is an asset class, right? As long as you can price it, as long as you can price the risk, it's an asset. So rates is one such asset which happens to be very meaningful for the prices of pretty much all the asset classes out there. So right,
Yep.
everything goes back to rates. Everybody's tracking very closely announcements by the Fed. This extra 25 basis points suddenly could mean 50% difference for some people's portfolio, right? So that's rates for you. And the reason these products are so popular is basically because rates affect everything and because they're so simple and capital efficient to trade. And that's what we're doing for crypto, right? So crypto has its own family of rates, actually more than one, multiple families of rates that have developed themselves over the past probably 5 years. I could say since 2020, probably not before that really. You've got lending rates, you got staking rates, you got funding rates for perpetual futures that happen to be the most famous and the most popular class of derivatives in crypto. Pretty much the only one that matters for the time being, unfortunately, not rates yet. And these are the things you can trade on Raw.
So from the rates amateur perspective, there's basically in the traditional finance, there's the T-bill curve, which acts as a kind of benchmark for the entire interest rate markets globally. And is there such a benchmark within the digital asset space? Because from my perspective, and maybe you can help me here, interest rates in crypto are even way more fragmented than the spot within the crypto space as well.
100%. And especially the lending market, obviously, we do not have the universally referenced benchmark, which is kind of foundation for the markets in general. And that's partially because projects like ours and products like the products we're issuing are not really available widely, and also because in the beginning of the market, people are not really chasing transparency and standardization because you get the edge from the things being opaque and private. Yeah. As the market develops, that kind of paradigm quickly exhausts itself, and suddenly you need a transparent, clear market, level playing field rules for everybody, and that's where benchmarks come in. So for the time being, unfortunately, any of the rates I mentioned, it's really hard to find that, right? Even simple things that seem simple, like what is Ethereum staking rate today? It's not a trivial question. And there are plenty of contestants now trying to become that benchmark for such a simple thing as Ethereum staking, which is all transparent and on-chain. And credit market, as I'm sure you know, are very private and very fragmented, and that's one of the problems we're trying to address.
So do you guys have an ambition to become the benchmark, or how do you see the market evolving within the next 5 to 10 years?
I think eventually there are different approaches to building benchmarks, but the only one that really provably works is creating a liquid market around the rate that people are trading, right? So it's like you're not trying to synthetically construct a benchmark out of some arbitrary parameters. You just let the market decide what the rate should be, and that becomes the benchmark in a way. We saw that some other mechanisms survived decades, like LIBOR, for example. Yet it was way more market driven than things we're seeing in crypto today. And eventually everything moves to that. So I think whether that's us or similar products or maybe a combination of multiple rates which are borne by liquid markets are going to become that benchmark. Hopefully we will play a significant part in it as well.
Yeah, we'll definitely wish you luck with that. But before we dive deeper into the structure, into the market structure, let's talk more about your background and why you decide to pivot into the interest rate markets, right? Because you are a serial entrepreneur. You have the background with, like you've spent decent amount of time with one of the leading institutional custodial firms, Copper, right? You've served as a chief product officer. So tell a bit more maybe about your background and why you decided to first pivot into crypto, and the second, why for the raw markets you've selected interest rates.
Sure. So we, like my background is similar to you. I'm a recovering TradFi aficionado. I started from equities initially. I started as a sales trader, then moved to derivative structuring. And I think my first exposure to fixed income products and rate products was through actually structures and treasury products and private banking like structured products. A lot of strategies, relatively simple or more complex, just not possible without some reasonable predictability of the cash flows, which in turn is not possible without the liquid rates market. And after that, I went into entrepreneurship. I ran a couple of startups, one of my own, which, as it happens with the first startup sometimes back in almost 10 years ago by now, didn't take off. Another one for one of my large shareholders. And before all, I served as a chief product officer at Copper. It was also a fun experience. Copper is one of the leading custodians, prime brokers in the space. And I joined the firm when it was a 35-people firm. And left when it was a 350 people firm. So it was a fun ride. And eventually, I was still at Copper and thinking, what would I like to do next? I knew I want to go back to entrepreneurship. And I think between ourselves as a custodian and the likes of yourselves at Finery with ECNs and prime brokers and all the rest of the guys, what we're trying to do, we're trying to create infrastructure for the institutions to come in and use all the familiar primitives that they need to be properly in the market. And when I was looking at that back in 2022, my determination was that basically that's done, right? So all the main bases are covered, and now it's more of an evolution than the revolution. There are not a lot of niches left. And then the next question was basically, when institutions are in, what are the things they're going to need? And what are the things which are still missing when they actually can trade crypto, or they can settle and trade real assets on chain? And we know that spot is there, options are there, futures are there. Rates is pretty much the only missing piece, and it's a cornerstone piece that just makes a lot of other things tick. So I thought, well, how about that?
Yeah, it does seem like a perfect match, but what do you see are the main obstacles that were 2 years ago and still today to actually make it a proper developed market within the crypto?
Well, I think, paradoxically, one of the most difficult things in our development in the past 2 years, right? We actually filed for the registration of the company 1 week before FTX. That was a perfect time. And I think one thing that people, I believe, still kind of do not understand perfectly well, that crypto is not that sort of 100x or nothing game anymore. I think we're done with that. That might be my speculation, but I think people who are still trying to make those bets rarely hit it.
Well, gambling always exists, right? In traditional asset classes as well. Like some trades, CFDs on like Tesla or S&P 500 with
crazy
like
leverage.
1,000 leverage.
That never goes away, but also now you have a proper market with a lot of very sophisticated players that create proper liquidity, which is very important for a lot of other things, right? And it's not really about risk management. It's about understanding that the simple strategies like, I don't know, basis that everybody has been trading forever on its own is not going to yield disproportionate returns anymore. You're probably still going to be able to make money on it, but it's getting more and more complicated. So suddenly, to do the very little next step after that, like for example, your trading basis, but you're not particularly happy with your basis, with your funding rate going to minus 25 overnight. Like, that's not great. So suddenly you're losing a lot of money on that trade. What do you do about it? And that's where we come in. And that is the very foundational piece of a lot of the other things you can build on top of it. And that is probably something that people are just discovering now. So when we were talking to potential clients 2 years ago, obviously right after FTX, everybody was mainly concerned with saving their rear ends and whatever was left of their books. And immediately after that, people started looking into what is the next big thing? What is the next big strategy? Again, paradoxically, as I was saying in the beginning, the bull run of the early 2024 was a little bit counterproductive to us because the market went back to familiar trades. And when you're printing $1 billion on the basis easy money, you don't have time for new cool stuff. And we are potentially the new cool stuff. And then kind of 6 to 9 months down the line, it came back. And now we're having very, very deep discussions with relatively sophisticated or very sophisticated investors looking into what can be done on the rate markets or using some of the rate primitives.
Perfect. And if we talk about the parallels with TradFi, like what are the key lessons that you think, like considering your background, were helpful while launching Raw Protocol?
Oh God, I think that kind of adjacent to my experience in TradFi. But when I was launching my first startup, I think one of the things I learned that what looks as innovation when you're sitting on the corporate side is not really what innovation is. So with that, the reason that one didn't take off was basically I missed the market maybe by a couple of years.
Yeah.
And what I was trying to build back then was valid a couple of years before. So today we're on a different side of that, right? When we started talking about rates to people at the end of 22, there was clearly a timing risk, right? Because people didn't know if the market actually will continue institutionalizing, whether the crypto will ever come back, right? Or maybe Sam killed it all for us and whatever. But you have to be forward looking. You have to take the timing risk is basically a big part of what you have to take as an entrepreneur. That's my take on it. If you want to try and build something meaningful, I don't have to tell you.
Of course, yeah. I think we both are facing and basically challenging and preaching for the same concept of institutional adoption. We were also quite early in the game with the ECN concept back 5 years ago. And I remember when we were trying to explain to some of the crypto native guys what is electronic trading via ECN, they were always wondering like whether we run a Telegram chat or something like that. So yeah, it's a bit more sophisticated than that. But now when we have proper TradFi traders and like the people from that background moving into the space, I guess this helps both of us.
Exactly.
And this will only continue. So talking about the market structure, interest rates are historically dominant by institutional players. Like there are no retail traders actually trading any of such products. And maybe that's because, and this is why the adoption and the knowledge of the market is quite limited. So can you, in brief terms, explain how the market structure operates in the TradFi? Like what are the key players and how is it different in the crypto space? So who are the key players in TradFi versus crypto?
Of course. So the question we get most commonly when we start talking about rates to people who are familiar with the asset class in TradFi is where are those 20-year kind of horizon corporates who want to hedge their rate risk? Because typically the two biggest groups of traders or operators in rate markets in TradFi are corporates or other people who have very long risk for whatever reason. It could be a pension fund or, I don't know, oil and gas company, right? Somebody who really cares.
Yeah.
Banks, obviously, because, again, if somebody is getting a mortgage for 20 years, bank has very limited borrowing facilities for 20 years, right? So they have to manage that. And on the other side, it gets professional swap dealers. So somebody has to price that risk. It's largely hedging driven. It's if you're a hedge fund, chances are you're trading rates, at least occasionally on kind of ad hoc basis when you see mispricing in the market. But predominantly, it's going to be that hedging flow and a little bit of speculative flow from the hedge funds coming in. Crypto is quite different, and it's not only the function of the market and market participants, it's the function of the rates themselves on the underlying, right? Because if you're talking about treasury rates, which is by far the most popular thing traded in TradFi.
Yep.
Treasury rates display some volatility round about every 10 years.
Well, especially over the last few weeks with with Mr. Trump. Yeah,
absolutely. So you've got that, and for the next 10 years, it's going to kind of lie flat. That has been the pattern over the past 30 years or so, right? So you actually have to care about very long risk. You have to have very long duration in your portfolio. Perp funding rates are kind of different.
Yeah.
You can go from minus 20% to plus 60% in like 72 hours, right? So
or less,
suddenly, or less, exactly, depending on if it's Solana and on the DEX, then we're talking hundreds of percent, literally. So while that's actually the same product, the target group of clients and the use cases are very different. So by nature, it's a very short-term, either speculative trade or short-term hedge. So if you're sort of a mid-frequency perp trader, again, you're trading basis, you hold a position open for a while, maybe you're an options trader, and you hedge with perps or you do a bunch of other things. Suddenly you care about this couple of weeks when your hurdle rate on that trade can go from 11% to 60%. That's not great. Or other way around, drop from 30% funding that you're collecting to minus.
And that something. Might be different on different exchanges, right? Because on some...
It is absolutely different on all the exchanges. It's different. The methodology of centralized and decentralized exchanges are different. It differs from exchange to exchange. And even the biggest guys, if you look at Binance and OKX rates, whereas there is significant correlation over the period of time, but if you look at the sort of the spot rate, it's all over the place.
Yeah.
And similar things apply even to the trades which are more hedging driven, like staking, for example. So the core use case for our staking rate products are essentially making your stake into a fixed income product. So people think about it as like do 3.5% and 3% matter. Well, if you do it for the yield, it's actually about 20% difference in what you're earning on that. And some people do it for the yield. So even there, we're looking at the typical horizon, typical term of the trade is, we're talking 3 to 6 months, rarely longer than that. Yeah. And especially since our products are very capital efficient, if you're an active trader and not like an Ethereum hodler who just going to sit there for the next 3 years and just want your dividend to be fixed, then it's more of a short-term trade. It's very active. So majority of the flow that we've seen since we launched our beta last year is probably 80 to 20% speculation to hedging.
Yep.
Specifically, as you said, because the market is super inefficient. There are lots of inefficiencies, lots of value to be extracted, doing curve arbitrage, exchange arbitrage, like a bunch of other things.
So let's break down on the use case that you mentioned. So if a fund or someone is sitting in the basis trade, and basically the rate on one of those exchanges is like changing dramatically. Yeah. So how would a client using raw protocol can hedge themselves from that spike? Like, can you break it down to the use case?
Yeah, of course. It's very easy. You can get to any level of depth, but in essence, you basically, for example, if you're trading basis, that means you're buying spot, say on Binance, you're buying spot Bitcoin on Binance, and you sell short a perp, and you collect the funding. So you're hedged against the Bitcoin price fluctuations, and you're only collecting funding. Normally, funding on Binance will sit at 1 basis point every 8 hours, which is exactly 10.95%.
Yep.
So that's your basis clamped. So unless the market gets really volatile, that's what you're going to be earning. But once in a while, like it happens now every few weeks, it gets really volatile. And before the New Year's on the Trump trade, it went up to plus 60, and about 4 weeks ago, it was actually minus 29, I think, is the lowest point we've seen. So if you're a basis trader, what can you do, right? So you sit on that 11% and you hope that it's got to be around about that level. Suddenly, it goes down to minus 29.
Yeah.
So what do? You have to monitor that very actively. It's operationally heavy. It's computationally heavy. You have to decide whether you get in or out of that trade and like sell it and then buy it. That's a cost and could be quite a significant cost depending on your tier. instead of that, what you could do at the time when you open that basis trade, you go on Raw, you deposit a very tiny bit of collateral compared to what you have to deposit on Binance. We're talking the most expensive leg of that trade would be a spot. And we're going to be talking, like for the same notional for us, you're going to be needing anywhere between, I don't know, 2 and 5% of what you have to deposit for the spot trade. And you trade the same direction as a perp on Binance. So if you short perp on Binance, you short our future, and you choose the expiry. Typically, the most popular product is the front month. So today, for example, we're recording that at the end of April. So we're probably going to be talking the front month would be end of May.
Yep.
So you short month funding future, and you're hedged. You don't have to bother anymore. That's that. Whatever happens on Binance, whatever you receive as your funding payment on Binance is going to be what you pay on Raw, and instead you receive the fixed income stream. You receive the fixed rate. That's it.
So if we add up all the costs of the hedging, like what is relative to the basis trade? Because I think with a like 12 months, like the most simplistic basis trade that you can do today, like on Binance with, let's say, spot and Bitcoin and March futures, like March 2026, it's around like 7%. So out of these 7%, what would be the cost of hedging using Raw protocol?
Very little. So in terms of the amount of capital you'll need to deposit, it's tiny compared to what I have to deposit in Binance. So we're talking, again, maybe a couple of percent to be on a relatively safe side. It's not crazy. That 50x leverage on a rates trade, even in TradFi, is very normal.
Yep.
And in terms of the cost, you're going to pay, it's an annualized fee, so you're going to pay, depending on the time to maturity, if we're talking a monthly future, it's probably going to be around a couple of bips that you're going to pay as a trading fee. So it's a kind of a no-brainer if you do it at the right time.
Yeah, I think it definitely is. So yeah, anyone is doing basis trading and watching this podcast, definitely encourage them to look closer into what you guys are doing. Let's get back to the market structure, right? So you mentioned in the TradFi, like, if I can summarize that into like 3 key blocks or like 3 key types of players, right? The issuers, which I think this is also quite different from the crypto space, right? Because we do have established issuers in the space, like the governments, the corporates. We then have the supply side, the demand side, like those that just need to hedge. And then in the middle, we have all the financial intermediaries that do speculate on the inefficiencies. So as of today, also from like my perspective, I think the crypto markets are emerging from those like speculative use cases, right? So how do you see like the other 2 segments with the more natural, organic demand and like some sort of issuer space growing within the digital assets?
Issuer is the difficult one because it's hard to say who is the issuer in crypto, right? So if you're not talking about the spot products, then probably it's an exchange itself.
Exactly.
Right?
Yes, that was my point. It kind of seems that the existing benchmarks, right? Like the governments are replaced with Binances of the world that are defining their funding rate for perps.
Pretty much, and I guess I find it hard to see how that can be driven by the market itself, right? So probably at some point regulators come in and say, "Finita, guys, we need to develop some standards here.
We need to use roll apps." So
please, if the government is listening, please, we're waiting. Yeah, absolutely. So I think standardization will probably eventually come from the combination of efforts and understanding of the market that we are there and it's good for us, but probably will have to be enforced or suggested at least by the regulator. And I guess generally the segregation of duties in crypto is not great, right? So we got the exchanges initially, I guess that was not even by their desire at the time, had to become a custodian, an exchange, an issuer, a registration agent, whatever. Like all of the things in one.
Sometimes the market makers as well.
Sometimes the market makers as well. Yeah, sometimes the ECNs or like OTC desks or whatever, everything. And that's obviously for a bunch of reasons very obvious to people coming from the TradFi side. It's not going to last forever. And we are actually the way we're looking at it is we want to kind of bypass the centralized custodial exchange model altogether. We don't think it's going to survive for much longer. And we started building that as a DEX, which was an easier way to bootstrap liquidity for the early products. And now we're essentially going multi-custodial, and we think that traditional market structure, when custodians do their thing, and exchanges much buyers and sellers and give up the trade to a custodian to settle, is kind of the way to go.
So how do you see the transition from exchanges owning that? And sometimes if you own something, it's pretty hard to give it up to someone. So how do you see that transition? Because I think that what can really change the landscape, right, is the migration of price discovery of interest rates from centralized exchanges to more like interest rate focused platforms.
I think if you can draw a parallel again with the custody space that I'm kind of intimately familiar with, and I think the same is going to happen here, the main driver behind it has to be the investor, has to be the client. Right? So once the clients come in and say, hey, I would like an objective source of information, which I can rely on, because everybody's asking all the time, is Binance doing something fishy with their interest rate, with their funding rate? And you kind of cannot prove it, and whether you can even call it fishy, because, you know, they own the thing, and like they do not quite disclose the formula, but you can find some patterns. As long as everybody is making a killing on it anyways, nobody cares. Once the margins compress, which inevitably is going to happen, and people start losing money when things go wrong, that's when the investors start to care. And eventually, we already seen that largely, especially with the more TradFi guys coming in. For them, they've been through that before, right? They know how it works. They understand the risks. You don't have to explain. A lot of demand will come from that side, and you can already see, compared to 2020, 2021, I think power of the exchanges in the space is diminishing quite a bit, which they're still the biggest and the most.
Well, they still sit on a lot of cash, right? And with the recent M&As that we all hear, like crypto exchanges purchasing some licenses in the TradFi, I think that will be interesting to see how the market.
We'll probably see in the same way, like, you know, JP Morgan can do a lot of things under the same group, but there is a bit of a distinction going on. So eventually, the same rules will be applied.
So we've solved. Or like, I think we know in theory how that should happen with this price discovery migration. And what do you think about the demand side? Like right now, as you mentioned, most of the demand is coming from either like speculative use cases, and 20% of that is hedging. And if we talk about the hedging side, like who will be the main drivers for having like a more organic client interest in derivatives?
I think as you mentioned in the beginning, this is not a very retail-friendly product, predominantly because it's relatively complex to understand, right? But the way I normally describe it is if somebody ever had a fixed-rate mortgage, they kind of bought themselves an interest rate swap. They just don't know about it, but they're paying for it, right? And same thing should happen in crypto. So eventually, when people become more sensitive to smaller price fluctuations or understand the value of predictability, the way it has to happen is, again, speculation is not going away. In the same way, if you look at the perps markets, the liquid futures market in crypto exists not because people want delivery of their Bitcoin 1 year down the line.
Of course. But well, my point was you cannot go far with just the speculation, right? In order to have the speculative flow driving like the volumes, you need to have that core organic flow. So there's no one doing any mortgages on Bitcoin and Ethereum, at least for now. So where do you see that organic flow coming from in the next few years?
So you got the lending markets that's not going away, right? Finance is credit, and people will want to know what are they paying or receiving on their loan. You've got the staking, which has probably the best chance to become the proxy to risk-free rate in crypto. Anything to do with funding or options, which also kind of go back to funding, in the same way, people will get more sensitized to that. So professionals are already way more sensitized post-Athena. People understand the risks much better. Anybody who's using perps, who goes along on perps, is also not a massive fan of the hurdle rate spiking to 70%. So that is already happening, and the reason I started talking about retail is because I think a lot of action in crypto is still driven by retail. But in order for retail to quasi participate in the rates market, they do not need to press buttons on the exchange, right? They can go to their staking provider and say, I want to know how much I'm going to be making on this stake. So you basically would be looking at an interface of your wallet or your staking provider, and it says like, okay, it could be 4% or it could be 3.5%, but fixed for 6 months.
Yep.
Which one do you prefer? Same happens to a perp trader. You go to your exchange interface, and there is a checkbox that says, do you want the funding risk or not? Right? It's like you can get rid of that. And that's how retail will eventually participate in that market. And obviously, there's always going to be a professional flow. There is already a professional flow, and it's only going to get bigger.
Nice. And there are certain inefficiencies, like a lot of inefficiencies in the market today. And just I've checked the Aave rate for like USDTs. It's I guess it's almost historic lows. It's already below 2%. So how do you see like you guys can help equalize the market and the rates across different protocols?
Yeah. The thing is, a lot of people try to build the product on DeFi lending rates, specifically Aave, Compound, Maker, or I guess whatever the name is right
Morpho,
now. Morpho, Mellow. And the thing is, majority of lending in crypto is not happening on chain. Right? Majority of lending happens either in private credit or on exchange when you lever up your position, things like that. So that is the side of the market I'm more interested in. The DeFi side of the market is mostly driven, I guess, by convenience. And that's why, again, like, why would you lend your, Ethereum for less than 3.5%, then you can stake it at 3.5%?
Yeah, and USDT at like less than 2%, right?
Exactly.
So like this seems to be a clear arb opportunity, but you can't hedge.
For some reason, people not jumping on it.
Yeah, but you cannot hedge the Aave rate.
There you go. And I think Aave tried to do fixed rate market, and nobody really cared. They also did it in like structurally in some relatively weird way, because there was no market like ours. They had to put it at like 5-6 times X the rate of the float. Yeah. So it makes no sense. I think even those guys would have to, if you get rid of the regulatory arb, and if you get rid of the convenience aspect, if it's not just for people who are not comfortable passing KYC or find it difficult to move between fiat and crypto, so once that goes away, we shouldn't see the 2% rates on USDT anymore. So that's more of a structural thing than the real supply-demand thing. And we actually more focused on things which are happening currently, even though we're a DEX. In terms of the underlyings, we're more focused on things which are happening on the centralized side of the ecosystem.
So let's talk about the market size, right? Also, once again, going back to TradFi, like as of 2024, the total notional amount of interest rate market, I think it's already around $600 trillion US, which is like enormous. How do you see the size of the crypto markets today and like within the next few years?
So we looked at that at the end of last year, and so again, as you're saying, right, in TradFi, the rates market is about 4 times, even more, the total size of the global bond market. That is roundabout valued at around 130, 140 trillion, and the rates market is 600 trillion. So if we would be looking at similar multiples for the rates products in crypto, then I'm definitely doing the right thing. But even if I think we took very conservative projections looking at the size of the underlying. So for example, looking at the open interest of all the port positions open, or the total value of all the staked Ethereum and things like that. And we applied about a 50% coefficient on that, and it still comes to the values that would suggest that if the market develops as we hope it will develop, then in 2-3 years, in terms of the notional traded, rate products should overtake the perp products. And that is, I guess, for us, it's already a major development compared to where we are today. So today on Raw, we're trading around $2 billion notional every month. The open interest hovers around about 30 million. Again, it's very early for us. We just exited closed beta in the beginning of April. And we're hoping, we saw quite the substantial growth since we launched the beta in June last year, and we're hoping that it's going to ramp up even more now.
Let's now talk more about like the risks involved in that market, and probably 95% of all the derivatives trading, including interest rate derivatives, are traded OTC in the traditional space, right? Even like from 15 years ago when Lehman Brothers and AIG failed, it was quite obvious that part of the reason why that happened because the risks were not accounted that well. Because most of the trades that happened that time, they were OTC derivatives, mispriced, and clearly that led into what happened in 2008 and 9. How do you see doing the interest rate markets on-chain will mitigate some of the risks, but at the same time, may that limit the growth of the market because it will be like basically putting anything on-chain makes it more standardized, meaning less flexible in terms of like the OTC. So it's a bargain between making it standardized and safe and simple and transparent and making it maybe like bigger and more flexible.
Yeah, it's probably the hardest prediction to make, right? Because again, it will be predominantly driven by the client demand. Rates in particular are more professional style products, so the investors would understand the difference. The framework we developed allows you to basically trade and settle anything that looks like a rate on chain. And now we're doing perp funding. It's very easy for us to go to SOFR, right, or any of the TradFi rates. And the model allows you to essentially right now it's a liquidity pool, so where it's many-to-many kind of risk dynamics, socializing the risk. It could also be bilateral OTC trade, and it will work in exactly the same way. The biggest advantage, and I guess the disadvantage, is that if you do not meet your margin call, you get liquidated, and there's no one you can call, right? So
exactly.
I guess where the market will go with this, it's hard to say. I think as of today, there is way more requirement for just good products, which means as similar to you, right? It's deep liquidity, it's breadth of coverage of assets and pairs and for us underlyings. And that matters way more than underlying mechanics of the market. While if we're thinking about the TradFi coming in and things like tokenization of real world assets, which I guess is the end game for a lot of things we're doing, then suddenly it matters more. For today, I'm very focused on just creating the rates ecosystem around the biggest assets in the space, right? So such as Ethereum staking or top 3 trading perps.
Nice. So if we talk about the perps and like the staking, how do you construct the benchmarks and who helps you price that? Like who are the key participants behind that and what is the logic of the benchmark? Once again, drawing parallels like with LIBOR, which is the well-known benchmark in the TradFi. What is the benchmark that you guys are providing and how do you construct it?
So that's the beauty of it. So we are not like some people are doing like Oracle-driven pricing. You look at the floats and you have some obscure formula to divide the fix. That's not how we work, right? So the way we basically build it, it's pure supply-demand driven market. There's nothing going on there. You basically look at the floating rate in the fixed for float rate swap mechanic is basically informing your P&L.
Yep.
And that's pretty much the only reason it's there, right? And then what our market is doing is actually independently pricing the fixed leg, pricing the fixed rate. The way it's done is by you have a supply demand. Currently, you have a liquidity provider and you have a taker. We are building a central limit order book, which is gonna see the light of day very soon, and that adds additional transparency. You can see the depth of the market at different levels and things like that. We don't have anything to do with that. It's between the liquidity providers and the takers, and that is actually what our market is designed to do.
So do you disclose like how many liquidity providers and market makers are already involved in the market?
Not at the moment, but you can look at the list of our investors and guess.
Great, thank you. Now, also just always referencing to the TradFi, like ISDA decided to issue the guidelines for smart derivative contracts. How do you guys, are you guys involved in that process? How do you see that flow helping the industry and the raw protocol in particular?
No, I actually had a lot of discussions with ISDA back in Copper days, but for now, I guess I'm a little bit too small for us to get involved, even though I know the guys there quite well. I think for us, all of those things are signals that we're finally moving in the right direction, right? So ISDA for all the good reasons. It's a massive industry body, and it's a kind of consultative organ by its nature. It's always going to move slow. It's going to take time. They're always going to be lagging the market in a way, and we are certainly at the forefront of the market. To the best of my knowledge, we don't know anybody else who tried to build a smart contract-based rates exchange. People tried Vault-like products and some of the other things, but nobody tried to do that. And nobody tried to do that for funding rates, for one. That just, I'm not aware of any attempts to do that at scale. And I guess I would love to have a conversation and share our findings and our kind of mistakes and iterations with the likes of ISDA and other industry bodies. For the time being, just seeing that those guys are trying to look properly at using the networks for settlement of derivatives is great. That's what we kind of hoping for back in 21 and was really hard to come by.
Perfect. So, like, wrapping up the industry deep dive, what are the exact industry challenges that you see today for the market and for yourselves that are most critical to solve, like, today?
There is too much good stuff going on, and people are extremely busy. And getting the time and focus of the right people in the industry is exceptionally hard. And that's great for everybody, and it's great for us, it's great for the industry, but that's pretty much the biggest challenge.
Oh, yeah.
I guess you're well familiar with it, right? Majority of people, probably including you and me, we have the attention span of a 10-year-old kid just because of the number of things we have to deal with at a given point in time. So because what we're doing has to do something with education, and we're a new thing that requires a bit of focus and attention, once we get it, people immediately, it clicks.
That's why we're cutting this interview into shorts on YouTube, so that our listeners can look in the TikTok format, and hopefully we'll get more attention.
Some of the things I'm saying should be cut at least in 3 parts.
Exactly. Yeah, and like I'm totally with you on that, because we've been through that and we're still through that like educational cycle, right? When you're trying to bring something new to the market, especially when it's just a debundle of something that already exists. As you mentioned, like most of the exchanges are running everything all together under the same roof, and it kind of works. And until it doesn't.
Yeah, exactly.
And while it works, it's pretty hard to convince people that, guys, this is just not the proper way, and mid to long term, you're just gonna lose and you're gonna burn. So yeah, that definitely takes time. But luckily, yeah, it does work. It just need more.
And the advantage of crypto is the cycles are so short, right? So once you show up and you tell people this is gonna happen, you don't have to wait for 10 years for that to happen. Typically 12 to 18 months, people will figure out. They don't remember, like, although that guy told us, right? And that's when you start doing things.
Exactly. Yeah, it's a perfect example. All right, so what innovations, probably besides just the interest rate markets, are the most fascinating for you within the entire digital asset space?
Oh, there's so much going on. Difficult to pick. I think I'm always kind of biased towards finance, and even though there are lots of fun things happening in crypto outside of finance and DeFi, that's kind of where I live. So I think the most important one is probably that second iteration of private credit markets that we're seeing right now, right? Because we had back in 21, we used to have centralized lending. Pretty much none of those guys are around anymore. So probably that one didn't work. To the credit of DeFi protocols, all of them are still around, pretty much, all the meaningful ones. And I think now we're seeing the kind of, there are a bunch of projects, some of them in Asia, some of them here in Europe, some in the US, that are trying to address that private credit issue with different approaches. Some people are trying auctions, some people are trying like some kind of fixed rate markets, actually, and we're talking to them about creating some swaps on top. And that is such an important part of finance that it just cannot function without it. And even on the prime broker side, some of the biggest, like we saw the news of Hidden Road, probably the most prominent prime in the space, selling to Ripple. That's probably partially because it was so hard to come by proper balance sheet to lend to crypto traders. For a very long time, I know they struggled with it, even though they're like a massive player in the FX space, right? Of course. So once that is getting solved, I think a lot of things are going to be unlocked. And that what we spoke about in the beginning, transparent benchmarks, transparent credit markets, functional credit markets. That's the biggest advancement for my space, at least.
Perfect. So yeah, it was a great conversation. Really, I think it helped a lot myself and all the listeners to understand more on the digital asset structure and particular interest rates. So wrapping up the conversation, what are the 2 books that you would like to pick up and recommend to our listeners? One maybe from the professional side of things, something related to capital markets or anything that helped you throughout your career, and another one, something on the personal note.
Let me think. On the professional side, I guess my weakness and strength at the same time is that in everything finance, I'm sort of self-taught. I didn't go through the uni. I ended up in sales trading very early in my career through kind of the back door eventually. And I had to educate myself about the market. So I had to go through a lot of books and a lot of materials, and like from CFA to everything, to understand it. I think on the fixed income side, because a lot of people in crypto are coming from either equity or FX side quite often. And on the fixed income side, there are some foundational books that everybody knows, like Fixed Income Securities by Bruce Taunton and all that, which is on, I think, 9th or 10th edition by now. It's been around forever. And on the personal / still kind of semi-professional side, because as you know, crypto doesn't leave you a lot of time for personal life. I think probably it's a funny one, but Jocko Willink, Extreme Ownership, is something that has been really helpful to build a foundational culture of the organizations I've been working for, because it basically talks about the concept of owning the outcome, which is quite foreign to a lot of people who are not in entrepreneurial position. Which helps a lot to avoid a lot of friction that you see in the large organizations. And it's kind of funny. It's written by a military dude who is building it to promote his consulting business. So you have to take it with a pinch of salt. But I think it's really helpful to convey certain messages which are not very obvious until they are.
Actually, I didn't read this one, but we'll definitely do that. And thanks for your recommendation and thanks for the interview.
Thanks, Konstantin. Thanks for having me. It's a pleasure.